Namaskar. Hello and welcome to P Guru's channel. I'm your host Sri Iyer. Today I have a brand new guest, Saurav Jha. He is an economist and he's also an author. He has just come out with a new book, Negotiating the New Normal. We're going to talk a little bit about that, but mostly we are going to pick his brains as an economist, compare the banking sector in the United States, how India is faring as compared to that, also the overall economic situation in the world. So joining me also to guest host this program is Sri Narasimhan, and he will be also be part of this discussion. So let's welcome our guest, Saurav Ji. Namaskar and welcome to P Guru's channel.
Namaskar, Sri Iyer ji. I'm glad to be here.
Thank you so much. And I also forgot to mention to you guys, he has his own channel. He's an expert. He has been a regular in many YouTube channels. So you're going to get some priceless pearls of wisdom from him. And let's also welcome my guest host, Sri Narasimhan. Sri, can you please join, sir? Thank you so much, Sri. And thanks. And namaskaram to you also, Saurav. So I'm going to start the ball rolling to you, Saurav. How do you see, sitting in India, the American economy, especially the fact that the sudden rate increase from 0 to close to 5% now seems to have caught many banks in a surprise bind? Do you think the worst is over? Just give us an idea of how you see the American banking.
Well, if you look at the mid-size, essentially small to mid-size banks that failed in quick succession, they all had interestingly significant exposure to cryptocurrency, right? Of course, that's one aspect, but they had also piled up a lot on government securities, American Treasury bills, Treasury, right? And as you know, I mean, the readers would know at a very general level, and this is always true, bond prices, that is prices of fixed income securities, government securities are an example of that, are always inversely linked with interest rate movements, right? So whenever the interest rate goes up, the bond price will fall, because these are fixed income securities and people will obviously demand a lower price because they have a certain expectation of return from that particular security. So and new offerings will come in which will offer better yields. So the existing bonds will have to lower their essentially their price, the selling price, right? So the thing is, what happens is that what happened in the case of these banks is they held both a lot of cryptocurrency, they had a lot of cryptocurrency exposure, and they were also holding on to a lot of government securities. Typically, during downturns, commercial banks, increase their asset holdings of government securities. Now, that's a very rational and logical decision on the part of any commercial bank, but they have to also gauge when the downturn is getting over and rebalance their portfolios in a timely manner.
They did not do that.
Yeah. My view is that these banks did not manage to do that, right? They did not manage to rebalance their portfolios in a timely manner. And ultimately, this is also another facet of capitalism and of the kind of capitalistic model that you have. I'll just take an aside. In India, the RBI is nowadays looking very closely at the business model of scheduled commercial banks, what in India we call scheduled commercial banks. Although they keep saying that we don't want to interfere in the way they do their business, but they are looking very closely at their business models. Now, you can't really do that in America to the same extent that perhaps you can do it elsewhere. And the other thing is that, see, while regulation has been strengthened greatly in the United States post the global financial crisis, supervision may not have been. The Federal Reserve is not being able to do the micro level surveillance that it is supposed to do. Its macro stress tests may be good, its modeling and analytics may be good, but how good its analytics is also, again, the fact that they are not being able to look at the smaller and mid cap segment that well, that is a cause of concern. So the Federal Reserve may want to reevaluate its supervisory standards. Now, the question is whether these can lead to a contagion or not, right? This would be on the minds of everyone. It could lead to a contagion. There are signs of stress that have cropped up here and there, but then, you're also, because of the post-GFC world that we live in, there is this whole thing about too big to fail, right? So too big will not be allowed to fail. What are called systemically important financial institutions or CFIs will not be allowed to fail. So you saw what happened in the Switzerland. The UBS did an entire bailout of Credit Suisse. I mean, now the question is that are these things costless? Is the creation of new money, reserve money, or the use of balance sheet policies costless? In the long run, no. When you look at the consolidated balance sheet of a government, when I say consolidated balance sheet, I mean the balance sheet of not just the treasury, that is the government, but also the central bank of that country put together, right? When you do that, the government securities, which are the liability of the treasury, cancel out with those which are on the asset side of the central bank. Central banks typically hold government securities of their own government, right? But the reserves which were created, the commercial bank reserves which were created to pay for them by the central bank, they remain as liabilities, right? And if they are interest bearing, then the overall government continues to lose money. There's a cost involved. So there is always a fiscal, what I'm trying to say is, there is always a fiscal aspect to monetary policy. Okay, always. That fiscal and monetary policy will always be intertwined. So no matter how much anybody says that the central bank is independent, etc., every central bank can only have what is called instrument independence. That is what they will target for their monetary policy. Now, what is monetary policy? Let me go into that for 2 minutes. Overall, today, the monetary policy is simple. How the interest rate, a benchmark interest rate controlled by a central bank, impacts various other interest rates in the economy, right? And how to manage the transmission of that from the benchmark rate to the other interest rates. So, example, in America, the benchmark rate is the federal funds rate. Actually, the federal funds effective range. This effective rate, which is nothing but the rate at which commercial banks borrow from each other overnight in an unsecured, uncollateralized manner, right? Borrowing can be collateralized or uncollateralized. You may not have any collateral. Now, why do banks borrow from each other? Obviously, they have to maintain a reserve balance, a certain level of reserves in that system. And they also have to, for any foreseeable problems that may arise in liquidity. So that's part of the bank's liquidity management. These banks have obviously failed to do that. Not only have their assets gone sour, the banks I'm talking about in America, they have suffered huge losses on the asset sides, and they now have a liquidity problem. So what will the Central Bank of America, which is the Federal Reserve, do? Obviously initiate emergency liquidity measures, since the central bank is the lender of the last resort anyway. So that is going to see the asset size, the asset size of the Central Bank of America, which is the Federal Reserve, go up even further. So, and the commensurate increase in liabilities also. Whenever assets go up, liabilities have to go up in a double accounting balance sheet, obviously, right? So the bottom line is America is not being able to pull out of the easy money policies that it had instituted. It has managed to raise the federal funds rate, the target range for the federal funds rate, in a bid to control inflation. And just aside, most of the central banks today, those who do inflation targeting, they usually have an inflation rate target, some target inflation rate that they have to meet. In America, from 1977 onwards, it was a 2% target rate for core inflation, which does not include food and energy prices, right? Inflation stripped of food and energy prices. In the wake of the pandemic, they have moved to an average targeting framework. What is an average inflation targeting framework? They are saying, no, that 2% is not a hard target. We want it on an average. So sometimes inflation will run over 2%, sometimes below 2%. Now, since the GFC, they were undershooting. They were consistently below 2%, right? They were in what is called low inflation, low growth mode. Very low growth, very low inflation, which some people call secular stagnation also, in the United States. In that period of secular stagnation, their employment, they had a lot of employment in sectors which were not paying well at all. Hence, there was this whole fight about the minimum wage. It has been found that to sustain a middle class livelihood, even lower middle class livelihood, you need a $15 minimum wage in America, which is what the Democrats are basically batting for, right? And the minimum.
Actually,
Huh.
Saurav, let me correct you there. It also assumes, I think, two earning members in a family.
Yeah, so but you need a $15 per hour minimum wage. Yes, you need to earning. Yeah, if you talk of
Yeah,
the
because
household,
right.
if you talk
Yeah.
about the household. Now the middle class in America has essentially stagnated for years and has actually declined. So even though because of this whole inflationary push, America's nominal GDP per capita income has gone up from 65 to $80,000,
Yes.
the the actual purchasing power of their population may have declined, right? The what is the real per capita income is basically stagnant for years and years and years. It's not really growing at any rate which is even 1%. Wages aren't growing really. Real wages, I mean real wages, not nominal wages. In even nominal wages were stagnant for a long time actually in America. So when I say nominal and real, it's very simple. Whenever you subtract inflation from any rate, you get real. So what happens is, because of nominal growth, you may think that something is growing, but its actual production has not grown maybe. It's just inflation which is showing up. Right. So in America, inflation was very low for a long time, and the real GDP growth rate was also very low. So America was just there. It was essentially, it had grown only 8% from the time of the GFC, the global financial crisis or the Great Recession as it is called, so on and so forth. It was a watershed movement in human history actually. So America's economy has been mostly stagnant, with most of the jobs being created in low wage sectors. Real estate, which was the great absorber of blue collar slack when manufacturing employment declined in America, their employment did not reach the same level that it had attained prior to the GFC, even as late as December 2019. Right?
Right.
So
Right.
you can imagine the impact there was on actual incomes in America, real incomes in America because of this sort of state. And throughout this period, the American worker was under deflationary pressure from the rest of the world, from the manufacturing workers of East Asia, and from the services workers of India, right? And some other places as well. Mexico was also in the mix. So they had no bargaining power per se. Even the pandemic has not really restored that bargaining power. You are not going to see a classic wage price spiral in America, where prices rise and workers are in short supply, so they demand higher wages. They immediately take the higher wages and spend them, and prices rise more, and then wages rise again, and so on and so forth, right? Which leads to ultimately to hyperinflation, what is called a classic wage price spiral, which has not been observed and won't be observed in America even now. That is not going to happen. So at some point, the Federal Reserve will begin cutting interest rates, especially in the interest of financial stability. You see, because these banks that are failing and others that are failing, who have positions that were made when the interest rates were basically at what is called the zero lower bound, they are going to be stressed like anything. So what do you do? Obviously, you can bail them out temporarily with emergency liquidity measures, but lending to the insolvent is never a good idea. You can keep evergreening loans, but it doesn't mean that the basic insolvency problem has been solved. So I definitely see a wave of consolidation in America in the financial sector, as happened during the GFC, and also in the real sector, because these guys, their customers are also going to suffer after all, right? They need loan turnover, they need new loans, they need working capital, so they are going to suffer as well. So there is going to be a decline in economic activity in America, and it's going to be managed using very creative monetary means by the Federal Reserve. The only real question facing the Federal Reserve is whether the imported component of inflation because of supply chain disruptions, will that sort of damp down quickly or not. If it damps down, then America will again manage the situation. If it doesn't damp down, then they have a problem, and I'll tell you why the problem is there. Now in economics, for a long, since the 50s, there has been, in fact, before that, since the 30s, there has been a debate about something called the quantity theory of money. Now, you will often hear in the press and other places, oh, money inflation, people are printing dollars like crazy. This is going to lead to hyperinflation in the future. But all through those years, it did not happen, right? Just the increase of commercial bank reserves, which is what basically printing money means. When you say that a central bank is printing money, it's not that they are just printing notes and then releasing it to the public. What it really means is they're taking assets from central banks and pushing and paying for those with newly created central bank money called commercial reserves, which sit on the asset side of a commercial bank. Right? The liability of a commercial bank is our deposits, the deposits that we make. The assets of a commercial bank are the reserves they have with the central bank and the loans that they make and whatever they have bought. Now, some central banks have bought very old Raphael Santi paintings also. That sits on the asset side of it's not a central bank, a commercial bank, right? It sits on the asset side of a commercial bank. They may have exposure to cryptocurrency. They may have bought BTC or something of that sort. That is also on the asset side. So the bottom line here is that there are various stress scenarios involved. If inflation goes down, then we are looking at a very different scenario. The Central Bank of America will manage it. The Federal Reserve will manage the situation. Okay, because their liquidity, they will be sacrosanct that even if you push in a lot of liquidity into the commercial banking sector, we are not going to see an ignition of inflation or a greater ignition of inflation there. Because what has been observed is that when you push in money into the commercial banking sector in the form of reserves, or what is called printing money in layman's terms, if you're in a low inflationary state, that has no impact. It just sits there. It just sits on the commercial bank's asset side. The reason for that is obviously simple. When there is low inflation, it means that aggregate demand in the economy is weak anyway. There are essentially depressed conditions in the economy. Who wants to take a loan in such a situation? So commercial banks also aren't eager to make loans. Neither is the public or firms. Neither households nor firms are very eager to take loans either. Okay, generally they may take small bridge loans, but nothing great. So they just sit there, and on top of that, you pay reserves. The central bank pays reserves on those, interest. Central banks pay interest on those reserves with those commercial banks. So in that sense, those commercial bank reserves are sterilized. You can keep getting the commercial banks to buy government securities. Then those government securities will be bought by the central bank and will be paid for with newly created money. And that newly created money will simply sit in those commercial bank reserves without igniting a loan-making cycle. But when inflation is running high and when people are running to make ends meet, okay, then the situation could be very different. It could be very different. Then commercial banks cannot deny credit on credit cards, right? They can't deny credit on many forms of arrangements that they have. Then that loan making cycle can kick in, and that money, when it enters the economy, the real economy, when it chases goods, will ignite further inflation. So those are issues there. So the thing is that it all depends on the inflationary outlook that the Federal Reserve sees. And that inflationary outlook, unfortunately, is contingent on geopolitical factors. The course of the Russia-Ukraine war, whether the South China Sea will hot up or not. See, if the South China Sea hots up, then the first thing that's going to go through the roof is insurance premiums for shipping. Right? That's pretty understandable. Till now, it has not seen any real surge, which is why we are all happy importing junk from China. But if you see that the insurance premium pressure kicking in for shipping, for freight essentially, then the cost model changes altogether. China is not in a position to do that, which is why probably it is not invading Taiwan, or it is not planning to invade Taiwan in the kind of time frames that the Pentagon thinks it is, because they'll have to factor that in. That is another thing that has to be looked at. That is going to create a huge inflationary shock if a war happens over there, in the South China Sea or across the Straits of Taiwan. So it all depends on the inflationary outlook. Bottom line, in America, incomes have been stagnant. The middle class has been declining. The pandemic created this tightness in labor markets because many people took their time to come back into the labor market. The direct fiscal support that was given to households also gave them the time to adopt a wait and watch attitude. But now that all that money has run out, now they're all coming back into the labor force in America, right? So that same damping down on wages will the effect of wages will continue to be under downward pressure. But they are not at the moment, but they will. That old downward pressure on wages will resume in America very soon. But America needs India to step up as a manufacturing base. There is no doubt about this. See, because there are a lot of things in India's favor. First of all, our cost structure, as far as the labor, the input from labor is concerned, even when adjusted for productivity, is lower in many sectors now. And new research will show this, right? New research will show this compared to many East Asian destinations. Then we are improving our infrastructure. So our sort of logistics outgo will drop down. You often hear in the press that 13 to 14% is our outgo. What we spend on logistics in India is equal to 13 to 14% of GDP, whereas the global average is closer to 8 to 9%. If we can bring it down to even 7 to 8%, we will have an advantage then. Typically, I'll give you an example. We have a disability in nominal terms, nominal, not real terms, disability of 9% in dollar terms as compared to Vietnam and around the same for China as well in various sectors of related to electronics manufacturing. So we have to look at how we get rid of that disability essentially. Right. Please ask your question.
Yeah. So at this point, I had one other question, but I want Sri to chime in, and I'll come back with my question a little bit later after Sri has had a chance to talk to you. Sri, go ahead.
What's going on in terms of the faith the nations of the world had trusted American financial system with, and what changed? What has changed over the last, a couple of years since the pandemic? And what is everybody's frame of mind? I know every nation has its own point of view, depending upon how it sees itself as a player in the world economy. But what's going on, for instance, in the minds of the other 6 players in the G7, right? The ones who hold a lot of American securities. What are they thinking?
Right. So let me start with something which is has more to do with geopolitics than anything. So in the 1890s, when the Russo-French détente happened, right? The Russo-French détente, France and Russia sort of got into an alliance with each other. The Russians greatly increased their holdings of French securities, French government assets. Right. So this is something that you've observed between Russia and China as well in the recent past. So this was entirely due to a new geopolitical understanding. It was not necessarily guided by any prudential approach to the matter. So that always has to be taken into account. But this is ultimately limited. The reason why the United States is the United States Treasury bills and government securities is where the world central banks park their reserves, their dollar holdings. That is the reason for that is not simply the geopolitical position of the United States. It is also because the United States provides the most liquid and deep markets for parking and is also a safe haven ultimately. Now, you may say that the United States has such a huge amount of debt, but so do others. Relatively speaking, the United States is still in a much better position compared to China or Japan. If you look at the total leverage of either China or Japan, it is actually greater than that of the United States.
Makes sense in terms of as a debt as a percentage of GDP.
And the United States, because the United States has liquid and deep markets for its debt. which China doesn't, and Japan has to an extent, but not to the same extent as the United States. And because in Japan, the Bank of Japan has been in quantitative easing mode for the last 35 years, almost 30 years, 33 years, right? They call it quantitative easing along with yield curve control. That is what was. So they are essentially the market now for government securities over there. Many primary dealers have left the government securities market in Japan. An example would be the Royal Bank of Scotland, which used to be heavily involved over there. So the United States market for government debt is still seen as not just a huge, super high volume market, but a liquid and deep market, and one where the Fed is not, the Federal Reserve is not really the market maker even now, right? So, and now the question is, but why have dollars at all? Why earn in dollars, etc.? The main thing is the United States is not only the largest consumer market in the world, it has also created a system in the world whereby others are comfortable in dealing in the dollar. So you have the petrodollar, so on and so forth. But also the fact remains that today when I want to make a payment to say Saudi Arabia, they would be more than happy to accept dollars because they can make a payment in dollars to someone else as well. So the network effects are very much in favor of the dollar at the moment. And the dollar has not declined in the last 2 years. The only place where the yuan has shown a slight bump is the trade currency. There is the currency finance market, trade finance market, the trade finance market. That is the only place. It has not made any headway in central bank reserves. Let me rephrase that. It has made some headway, and that is entirely due to the Russians starting to hold yuan-denominated government securities, right? So there was, but it is still well below 3% in terms of overall central bank holdings, that is declared holdings of various kinds of reserves. Central banks, of course, not only hold foreign currencies, they also hold gold and other assets as well, right? So in their what is called the reserves and in forex reserves, they are still below 3%, despite the Russians shifting towards them. And I don't see very many others shifting towards them. Anybody who can make a significant change to that number. And that number has declined between 2022 and 2023. It was at around 2.88% at its peak. It is now closer to 2.6%. I'm talking about the RMB. Whereas the dollar is holding steady at between 58 to 60%. Now the whole idea is, why would somebody leave the dollar? Only if they get something better. Is there anything better? No, there isn't anything better. There is no market for government debt which is equally liquid or deep. There is no other place which can be called a safe haven. With the Evergrande failing and the hidden debt in the form of local government financial vehicles, the hidden public debt of China, not to mention their own state of affairs on the economic productivity front, who's going to say that that is a more stable place to park your reserves than America? Europe doesn't compare either. The euro was the one which had the short, right? The euro comes after the dollar in the reserve sweepstakes. It had reached a peak close to 30%. But that was much earlier. Who will invest in a declining euro of today, Europe of today? Right? I mean, and it could be a declining euro also, because I don't see the euro holding its strength in the future against other currencies. But the dollar is holding its strength, despite the fact that now the inflation differential is actually in favor of many emerging economies, in the sense that they are experiencing lower consumer price inflation than America is, which was not the case earlier. So, but if that changes, if America experiences lower inflation than emerging economies or other G7 members, and is also the safest haven, is also has the most liquid and deep capital markets, then dollar supremacy will endure.
Yeah,
Not
the cowboy.
Yeah.
The cowboy gets back on the saddle.